Welcome back to another Explainer. Today we're diving into Elevance Health's Q2 2026 earnings release, and let me tell you, if you want to see what a high-stakes, multi-billion-dollar corporate balancing act looks like in real time, you are in the exact right place. We're looking at a fascinating tug-of-war today, absolutely massive revenue generation pulling on one side, and some pretty intense operational friction pulling on the other.
Okay, just to wrap our heads around the sheer scale here, we got to look at this number, $49.8 billion. That is the operating revenue Elevance Health generated in just 3 months. They are literally managing billions of dollars in premium revenues, claims, and healthcare services every single week. It's just staggering.
So here's how we're going to break this all down today. 1. Q2 2026 earnings highlights. 2. The business segment breakdown. 3. Carelon, the growth engine. 4. Headwinds, costs, and membership. And finally, number 5. The road to 2027.
All right, part 1, Q2 2026 earnings highlights, exceeding expectations.
Elevance didn't just meet expectations this quarter, they actually blew past them. Operating revenue ticked up slightly, about 0.8% year over year, hitting that $49.8 billion mark. But the real star of the show? The bottom line. They posted an adjusted diluted earnings per share of $7.45. Now, it is worth pointing out that this was heavily supported by an 80-cent per share net below-the-line benefit. But still, riding that high, management took a bit of a victory lap. They raised their full-year adjusted EPS guidance to at least $27 and bumped their operating cash flow guidance to at least $6 billion.
Moving right along to part 2, the business segment breakdown, anatomy of a conglomerate.
To really get how they pull those top-line numbers off, you have to realize that Elevance is essentially 2 giant businesses living under one roof. First, you've got the traditional health benefits side, bringing in a massive $42.7 billion in gross revenue. And second, there's their healthcare services arm, Carelon, which generated $19.2 billion. Now, I know what you're thinking. If you do the math, those gross numbers are way higher than the $49.8 billion total. That's simply because it doesn't include the $12.1 billion in inter-segment eliminations. Basically, these two halves do a ton of business with each other.
Let's look a little closer at the bedrock of the company, health benefits. You probably recognize the big flagship brands here, Anthem and WellPoint, covering traditional, commercial, Medicare, and Medicaid insurance plans. This side of the house grew revenue by 3% year over year. Why? Mostly because of higher premium yields. In short, they were able to price their insurance products a bit higher, which definitely helped offset some of the looming challenges we'll talk about in a minute.
All right, flipping over to part 3, Carelon, the growth engine, fueling the future.
So if traditional insurance is the bedrock, Carelon is the rocket fuel. This segment covers Carelon RX, that's their pharmacy benefit manager, and Carelon Services, which handles stuff like behavioral health, complex care, and clinical solutions. With a massive $19.2 billion footprint, it is very quickly becoming the star of the show.
And you can literally see the momentum. Carelon jumped from $18.1 billion in Q2 of last year to $19.2 billion this quarter. That's a highly impressive 6% year-over-year leap. When you stack that 6% growth rate up against the 3% we saw on the traditional insurance side, it's crystal clear why management is putting their foot on the gas and steering toward this segment. So what's actually driving that 6% jump? Well, the filings highlight 3 main things. First, they're doing a great job scaling Carelon Services' risk-based solutions. Second, Carelon RX is seeing really solid product revenue growth. But the third driver? That's the real bottom-line winner, improved profitability in their specialty pharmacy division. They aren't just moving more volume, folks, they're actually capturing way better margins on those complex, super expensive medications.
But of course, it wasn't a totally flawless victory lap. Let's look at part 4, headwinds, costs, and membership. This is the push in our tug-of-war.
To really understand the headwinds pushing back against Elevance right now, we need to quickly define a crucial piece of industry jargon, the benefit-expense ratio, or as you might know it, the medical loss ratio, the MLR. Put simply, this is the percentage of premium revenues the company actually spends on medical care and healthcare quality improvements. The golden rule here? A higher ratio means a higher chunk of their cash is flying right back out the door to pay for patient care.
And, well, here is where the friction starts. The benefit-expense ratio spiked from 88.9% a year ago up to 89.7% this quarter. Now, an 80 basis point increase might sound tiny, right? But in the razor-thin margins of healthcare, that is a highly significant jump. Elevance points the finger directly at elevated medical cost trends in their government businesses.
Basically, people are utilizing more healthcare, and Elevance is footing the bill.
Then we've got the elephant in the room, membership attrition. In just 3 short months, Elevance's total medical membership dropped by an astonishing 469,000 members. Both the individual and Medicaid segments took pretty steep hits. Now, the company says this was driven by a known commercial fee-based transition, plus some anticipated attrition in Medicaid and ACA plans. But, anticipated or not, losing nearly 500,000 members in a single quarter, that's a tough pill for any company to swallow.
And then, buried deep in the corporate adjustments, we hit this massive sudden liability.
Yep, a $935 million hit. So what exactly vaporizes nearly $1 billion overnight? According to the filings, it's their best estimate for potential exposure related to a CMS notice about historical Medicare Advantage risk adjustment data. Now, government audits, they're totally par for the course in Medicare Advantage. But this perfectly illustrates how a sudden regulatory review can create a massive financial crater that a company just has to accrue for and absorb on the chin.
Which brings us to our final section, Part 5, The Road to 2027, Balancing Act.
So here's that core tug-of-war we talked about at the top of the explainer. Elevance has to carefully manage the very real friction of rising medical cost and shrinking membership, while simultaneously finding the capital to heavily fuel their high-margin growth engine, Carelon. It's a seriously delicate balance.
So how are they handling it? It's the classic spend money now to save money later playbook. Their adjusted operating expense ratio actually ticked up to 11.0% in Q2. Why? Because they are actively accelerating targeted investments. They're pouring money into medical cost management, simplifying the member experience, and driving operating efficiency. They're essentially taking their top-line gains and pumping them straight back into Carelon's value-based solutions. And the ultimate goal of all this maneuvering? President and CEO Gail K. Boudreaux put it this way: "These actions will strengthen how we operate, improve consistency over time, and reinforce our confidence in returning to at least 12% adjusted EPS growth in 2027. So, absorbing that billion-dollar audit, making those heavy targeted investments, right now, it's all explicitly designed to build a rock-solid, resilient baseline for double-digit earnings growth next year."
Wrapping up our explainer today, you really got to hand it to them. Managing a $49.8 billion quarter is literally an operational masterclass. Elevance Health is navigating a major inflection point right now. It requires extreme discipline to keep their traditional health benefits engine stable while absolutely hitting the gas on Carelon.
Which leaves us with one final, really critical question to chew on. Can Elevance successfully manage those creeping medical care costs to actually hit that ambitious 12% growth target in 2027? If you're tracking this stock, the medical loss ratio is the exact metric you need to keep your eyes locked on in the coming quarters. Thanks for hanging out with me for this deep dive, and keep learning.